Hello everyone, this is M. Jemima Suganti, Assistant Professor from Department of Commerce CA. In this presentation, we are going to see the topic Profit Prior to Incorporation. The topic covered here is Profit Incorporation, meaning the steps to determine profit prior to incorporation, or whether loss to incorporation. The third item is list of expenses to be allocated on the basis of sales ratio. The list of expenses allocated on the basis of time ratio with the small problems. Profit in prior to incorporation. So what is profit prior to incorporation? When a running business is taken over from the date prior to incorporation or commencement, the profit earned up to the date of incorporation or commencement is known as profit prior to incorporation. The same is to be treated as capital profit, since these are profits which have been earned before the company came into existence. In short, we can say that the profit earned after the date of purchase of business is called profit prior to incorporation, and the profit earned before the date of incorporation is known as profit prior to incorporation. That is, it is treated as pre-incorporation period. Thus, any profit or loss made before incorporation is known as profit prior to incorporation, which is treated as a capital profit, and the same cannot be distributed as business profit. The same is to be transferred to capital reserve, may be adjusted against goodwill. Loss prior to incorporation is treated as a capital loss, and hence the same is shown under the head miscellaneous expenses or miscellaneous expenditure in the asset side of the balance sheet. The steps to determine pre-incorporation profit or loss. First, we need to prepare trading account for the whole period. The second is time ratio and sales ratio. Net profit statement to analyze pre and post incorporation periods. Time ratio can be calculated by taking pre-incorporation and post-incorporation period. That is, it is calculated after considering the time period. That is, one period is required to calculate the period falling between the date of purchase and the date of incorporation, and the period between the date of incorporation and the date of presenting the final accounts. Here, a small example is given. Pre-incorporation period is 3 months, post-incorporation period is 9 months. So, total 12 months, that is 1 year. Therefore, time ratio calculated is 3:9. We can simplify it. So, 1:3. The next one is sales ratio. Amount of sales is calculated for the period pre-incorporation and post-incorporation. So, it is calculated on the sales taken place during the pre and post-incorporation period. Next is list of expenses allocated on the basis of sales turnover. First, gross profit, selling expenses, advertisement, carriage outwards, godown rent, discount allowed, salesman salary, commission to salesman. That any expenses happened under the head of sales, or we can say it any expenses that is related to sales is allocated on the basis of sales ratio. That is selling, for example, selling expenses, it automatically relates to the sales. Advertisement, when we spend money on advertisement, it automatically increases the sales of the company. So it is calculated on the basis of sales ratio. The another is carriage outward. So we are taking the goods for the process of distributing to the market. So it is the activity of sales. So it is allocated on the basis of sales ratio. Discount allowed, salesman salary, commission to salesman. The list of expenses allocated on the basis of time ratio. First, office and administration expenses, salaries to office staff, rent, rates and taxes, depreciation on fixed assets, printing and stationery, insurance, audit fees. So any expenses that is related to time period, that is the expenses may occur monthly, it is allocated on the basis of time ratio. So office and administration expenses will occur every day. So the amount we have to allocate it on the basis of time period. Salaries to office staff. So every month the company has to pay salary to their employees. So it will happen every month. So it is automatically related to the to the time ratio. Rent, rates, taxes, we have to pay that rent on the time basis. Depreciation on fixed asset, printing and stationery, insurance, audit fees. So it should be allocated on the basis of time ratio. So let's move on to the small problems, example problems, so that we can easily understand how to calculate profit prior to incorporation period. So Ganesh Limited was registered on 1797 to acquire the running business of Sunil and Company with the effect from 1197. The following was the profit and loss account of the company on 31st 12 1997. You are required to prepare a statement showing profit earned by the company in the pre and post incorporation periods. The total sales for the year took place in the ratio 1:2 before and after incorporation respectively. Here, first we need to find is time ratio and sales ratio. So how we should find time ratio means we have to take the date in the given problem, that is the Ganesh Limited was registered 1797. That date is referred as incorporation date or commencement date as a running business on 1197. That is the business have started their journey on 1st January. They have incorporated or got the certificate was registered on 1797. So the two dates and the year ending date is 31st 12 1997. So the three date have to be taken. So we need to classify into two, pre-incorporation period and post-incorporation period. So pre-incorporation period, the company have started on 1197. So they have got registered 1797 97. So once after 1797, the company turned into a registered company, or it got the incorporation certificate. So before 36 it was a normal running business. So 1197 to 36 1997 is taken as a pre-incorporation period. So balance 1117 to the year ending date is 31st 12 1997 is the post incorporation period. So January, February, March, April, May, June. So up to 6 months it's taken as pre-incorporation period. After July, August, September, October, November, December. The year ending date is December. So that 6 month is referred as post incorporation period. So the ratio is 6 is to 6. So the total 1 year, that is 12 month, we should get the answer. So the total ratio is 6 is to 6. If we add that, we will get 12, that is 12 months is equal to 1 year. We can simplify into a small amount, a small ratio, that is 1 is to 1. So time ratio is 1 is to 1. And we need to find sales ratio. Here the sales ratio is directly given, that is 1 is to 2. They have given in the sum directly, so we need not to find it out. Here the expenses are given. So first, to office expenses, to formation expenses, to stationery and postage, to selling expenses, to director fees, to net profit. Credit side by gross profit they have given. So we need to find what items to be allocated in sales ratio and what are the items to be allocated in in time ratio. If we have find it out that two items to be allocated easily, we can easily made the problem. So here the tabular column have to be divided like this. First column particulars, second column basis of apportionment, third column total, next pre-incorporation period, post-incorporation period. So first gross profit have to be taken because the income have to be taken. After that the expenses items have to be listed out. So we can easily find out the income minus expenditure. That is, we can easily, after deducting the amount, we can get the answer profit prior to incorporation and post incorporation period. So first, gross profit. Gross profit is referred as income for the company. So gross profit have to be allocated on the basis of sales ratio. So we have seen in the previous slide what are the items to be allocated in the sales ratio and what are the items to be allocated in the time ratio. So gross profit comes under the head of sales ratio. So the sales ratio is 1 is to 2. So the total amount for the sales is 2,25,000. So we have to divide 2,25,000 into 1 divided by 3. 2,25,000 into 2 divided by 3. So for the pre-incorporation period, the amount will be 75,000, and for the post incorporation period the amount is 1,50,000. So we have to find out like this. Then next is expenses. We have to list it out, the expenses. First is office expenses. So office expenses to be allocated on the basis of time ratio. So the total amount is 54,000. The ratio is 1:1. So 54,000 into 1 divided by 2. 54,000 into 1 divided by 2. So the ratio is 1:1. The amount is easily calculated. So for the pre and post, the same amount is followed. So for pre-incorporation period 27,000 and for post-incorporation is 27,000. The next expenses, stationery, printing and stationery. So that it is the time ratio. On the basis of time ratio it is calculated. The total amount is 5,000. So 2,500 for pre-incorporation period and 2,500 for post-incorporation period. The next item is formation expenses. So it did not come under the sales ratio or time ratio. So where we have to put? Here we have to allocate that expenses directly to the post incorporation period. So the allocation, the total amount is 10,000. So we can directly put in the post incorporation period column. Next, the item is director fees. The director fees also have to follow like this. It comes under the post incorporation period, that is 20,000. Directly we can put it on the post incorporation period. Next item is selling expenses. So selling expenses comes under the head of sales ratio. The sales ratio is 1:2. The total amount is 60,000. So 60,000 into 1 divided by 3. 60,000 into 2 divided by 3. The amount is 20,000 for pre-incorporation period and 40,000 for post-incorporation period. So after listing out, posting all the items for pre-incorporation and post-incorporation, so we need to add the total expenses amount. After that, income minus expenditure, that is the income. Here only one item have came, gross profit. So gross profit minus the total expenses. So we can easily find out the profit prior to incorporation and profit prior to post incorporation. So the answer is 49,500 for pre-incorporation period and 99,500 for post incorporation period. Let's move on to the another problem. A company limited was incorporated on May 1, 2008 to take over the business of X and Company as a going concern from January 1, 2008 are as follows. The profit and loss account for the company A have been given. So first we need to find this time ratio and sales ratio. So for that, first we need to find time ratio. We can take on that. So the company have incorporated on 1st May. So when the company have started as January 1, 2008. So from January 1 to 30th April is the pre-incorporation period, that is January, February, March, April. So on 1st May the company was incorporated. So it comes under the post-incorporation period. So May, June, July, August, September, October, November, December. 8 months. So 4:8. So again we can simplify it to 1:2. So the time ratio is 1:2. So again we need to find sales ratio. For that, the total turnover for the year ending 31st December was 5 lakh divided into 1,50,000 for the period up to May, that is pre-incorporation period 1,50,000, and for post-incorporation period rupees 3,50,000. So the ratio will be 3:7. Here the list of items have given, so we need to prepare the profit prior to incorporation statement. So first column particulars, second basis of apportionment, total, pre-incorporation period and post-incorporation period. So the income item have to be taken first. Here the income is only one item, that is gross profit. It comes under the head of sales ratio. The amount is calculated on the basis of 3:7. 3 in 1,55,000 into 3 divided by 10. 1,55,000 into 7 divided by 10. The next item is salary. Salary is calculated on the basis of time ratio, that is the time ratio is 1:2. Next, interest on loan, it is calculated on time ratio. So the amount is 1,000 for pre-incorporation period and 2,000 for post-incorporation period. The next item is rent and taxes. It comes under time ratio. The next item is insurance. It should be allocated on the basis of time ratio, that is 1:1. The next item is electricity charges. It comes under the head of time ratio. The amount is 2,400. So for pre-incorporation 800, for post-incorporation 1,600. The next item is auditor fees. It comes under the head of time ratio. Next, office expenses comes under the head of time ratio 1:2. Next, bank charges, time ratio is allocated, that is 1:2. Next, director fees directly allocated in the post. Next, preliminary expenses, it is also directly allocated to the post incorporation period. Next, commission allocation to the post incorporation period. When it is commission to salesman, it should be allocated on the basis of sales ratio, but it have given that simply commission, did not mention what commission has been given. So it is directly allocated to the post. Next, advertisement comes under the head of sales ratio. Discount comes under the head of sales ratio 3:7. Carriage sales ratio, bad debts sales ratio 3:7. So all the items have been allocated on the basis of time ratio and sales ratio. So we need to add the total expenses. After adding the total expenses, the income can be deducted by the expenses. So the profit prior to incorporation amount is 14,883, and for the post incorporation period 41,117. So these are the model problems. We can easily find out the profit prior to incorporation for the company. So I hope you have understood the concept within small example problems. So see you in next video, next presentation. Thank you for watching and listening. Thank you.